And I'm based out of the Nairobi office. Welcome all to the Fashionomics Africa Accelerator online program. Today we will be covering raising investment through sources of financing and optimal capital structure. Kindly note that the translations are available in English, French, Portuguese, and Arabic. We request that you select the language of choice. Welcome to today's session, and as you wait, please turn on your cameras if you can, and share in the chat what you're looking to get out of the session. Before we start, here are some ground rules. Switch on your camera if you can. Use the chat box to ask questions. Kindly do not raise your hand. We request that you use the chat box to ask questions. What we discuss here stays here. Your microphone will be muted, and again, we request that you use the chat box to ask questions. Participate actively and also ensure that you give space to others to participate. Please ensure that your Zoom name matches your registration name. This is for the purpose of taking attendance. Attendance will be taken anytime during the session. So again, we ask that you ensure your Zoom name matches your registration name so that you are not marked absent. Today, our facilitator is Rofem Egbe, who is a portfolio associate at Growth Capital by CC Hub. Rofem has previously worked as head of investment banking and as an investment analyst. He comes with a wealth of knowledge on raising investment through sources of financing and optimal capital structure. We are delighted to have you here with us, Rofem. Welcome to today's session. The floor is yours.
Thanks, Naomi. Good afternoon, everyone, or good morning, wherever you are. So it's great having this time with you guys. First of all, congratulations on being accepted into this program. And I'm very sure that you've had very intellectually stimulating time with the team. So today I'll be talking largely about like raising capital and raising financing for your business. So we'll largely be talking about where you can find capital and how you should think about structuring your capital. So basically the two portions to today's sessions. There's the first part, which is sources of financing, and then there is the second part, which is the optimal capital structure. So I'll begin. So like you mentioned, there are two parts to this, basically, which is sources of capital, sources of financing. So what they are, where to find them, then how to think about structuring your financing. Because what we realize is that a number of startups know about, or a number of entrepreneurs know about the type of financing you can get, but they don't necessarily understand what is right for them at a certain point in time. So during the course of this, during the course of the next hour, we're going to, the goal is for you to be able to understand what capital is available for you, how to think about putting together that capital, and then also how to expectations you might have when speaking to investors. So we'll start off with sources of financing. So basically, as an entrepreneur, before you started your business, the major headache you had, or the major challenge you had, was, how do I start the business, right? So I have a business idea, and I want to do XYZ. Say I want to make shoes, or I want to make ready-to-wear dresses and whatnot. And you're like, okay, I have a great idea, right? But I don't have money, right? And money really is like the major challenge for anyone doing business in Africa, doing business around the world. And it doesn't just start when you're beginning your business. It's something that is always going to be with you for the life cycle of your business, right? So don't think that, okay, I just need enough capital to start, right? Once I start, I'll be good. It's something that constantly you constantly need across the life cycle of your business, which we'll talk more about later. So businesses need money for a variety of reasons, right? First of all, you want to start your operations. Say you want to start your fashion business, so you want to rent a store, you want to buy sewing machines, you want to buy your equipment, you want to buy fabric and whatnot. Then the other thing is that you need working capital, right? So yeah, you're launching a fashion line, right? And you have your machines, you have your rent, you have all of that stuff, you have your hardware, but then you need the soft things. You need the fabric that you need to start out to make the first set of clothes, the first set of inventory, the first set of stock, right? Or you might need to be able to pay artisans or workers or employees, basically, that will help you produce this apparels and items, right? Now this forms your working capital, right? Then the other bit is you start your business, right? And you want to basically expand from, say, making 100 dresses a day to making 500 dresses a day. And that means that you have to buy more sewing machines, you have to buy more finishing machines and whatnot. So you typically would think of, okay, I need to acquire assets, so I need to raise money for that. Then there's growth and expansion. So you're in Nigeria, or you're in Kenya, or you're in one city, or you're in one location, and you want to move to the next location, or you want to create a new set of lines, right? So like, let's say you've already started with clothing apparel, and you want to go into leather work, or you want to go into accessories, or you want to go into skincare and whatnot, or cosmetics, right? Then the other bit is that, I started up my business and I raised a debt from the bank, right? And I'm doing really well, and investors like me. But I don't want to continue to pay interest, right? So that means that I can raise I can raise money to be able to pay off that debt, right? Now that's what we call a debt restructuring. Now this is one other way in which entrepreneurs use money while they raise capital. So now there are different types of funding, right? As entrepreneurs, or as when we start understanding business, we typically hear about debt, which you know from going to the bank, or going to a money lender, or going to a leasing house, or an asset financer, or someone who gives you like high purchase, say for equipment and whatnot. Then equity, which is some of the money that I saved up to start my business, money I got from my family and friends, right? But then funding comes up. Funding is a spectrum. It starts with equity on one side and ends with debt on the other side. Now, in between equity and debt, there are different types of funding. There's quasi-equity, which are typically convertible. So they're similar to both equity and debt. And we'll just talk more about them later. And then there are other things like grants, crowdfunding, factoring. Now, this basically means that as an entrepreneur, there are more than two ways for you to raise capital. There are more than two ways for you to actually fund the operations of your business, whether it's starting out, or whether it's expanding to another country, or whether it's expanding to a new line, or whether it's just getting working capital, right? So in this session, we will touch briefly on each one of these categories. So before we go into each type, right? I have an exercise for the group. Right? And what I want you to do is tell me people you know who provide equity, debt, or grants. So you can put that in the chat box. I'd like to see what your awareness is of people who fund So Adenike says VCs. So MasterCard Foundation, grants, local. Yeah, I like the engagements. So any specific kind of banks that you know that's fund equity and that fund rather debt. Okay, AFTB. Good. We seem to have a very active group. So can anyone tell me any specific names of a VC that can fund equity? So I've seen Verod. And someone says Fashionomics, BOY, Y Combinator, to Illuminate Foundation. Jim, interesting. Textiles. All right. Those are some very interesting names. Then it's good to know that that you're commercially aware, because one of the biggest challenges with us entrepreneurs is knowing who to speak to, right? Now the problem with knowing who the problem with is not just, or rather, you finding money doesn't just end at you knowing who to invest, who to meet for investment, right? Now, the thing about investors or people who provide capital is that they have criteria, right? So whether it is the debt providers, or whether it's equity providers, they all have criteria. And there's a reason why entrepreneurs today find it hard getting money from the banks, or finding it hard getting money from equity investors. And that's largely because an equity investor has a particular thing that they are looking out for. So they have so every investor has a risk, whether equity or debt. They have a risk they can take on, right? And businesses at different stages have different level of risk. But then also, because of that risk, the capital provider has a certain return expectation or a certain criteria that you must meet to be able to disburse capital to you, right? So what is good for an equity investor is different from a debt investor, right? Now, an equity investor is more likely to take more risk than a debt investor. And even within the equity investments, there are different players in the equity space, right? There are people who are more risk tolerant than the others, right? Now, the biggest challenge for you as an entrepreneur when going to reach out to these guys is not understanding where they are positioned and asking them for having an investment ask that does not meet their criteria, right? So briefly, we'll just talk about the different types of funding and their characteristics, and just give you a sense of how they map out across each other, right? So I can see that a number of people in the group have talked about how cumbersome it is to get funding, and really what is cumbersome is different people have different approaches to invest in and certain things they look out for. But basically, the different characteristics of different types of instruments. So whether it's equity, whether it's quasi-equity, whether it's debt or grants. So in equity, there typically are two types of equity you see. There's the common equity, and then there's preferred equity. Common equity is basically simply the number of shares, simple shares that issued by companies, right? But then certain investors don't just want the same type of rights or the same type of shares that a founder has. So certain investors want special rights because of the kind of risk, because of the kind of risk that they are willing to take on the business. So some investors might want to get out, want certain protections, right? Even though they're providing equity. So they will ask for certain rights, which makes the preferred equity. So you might hear of ordinary shares and preference shares. So preference shares are basically preferred equity, which basically are shares that have special rights to the holder compared to ordinary equity. So this could mean that in the situation whereby a company is dissolves, the preferred equity holder gets their money first before the ordinary shareholder gets their money. It could also mean that the preferred equity holder is entitled to a certain kind of dividends, but at the end of the day, it's equity, right? And they still have rights to the ownership of the business. They will also have voting rights, and basically the difference between the equity and quasi-equity and debts is that there is no repayment of principal. The only time in which the shareholder gets their money back is when they sell their shares, or when they sell their shares, or when the company buys back their shares. Then there's no interest element to it, although preferred equity might have some interest element to it, but it's structured as a dividend. Then there's no tax benefit for you if you issue equity to investors, right? Then from risk perspective, having more equity than debt is very, very helpful because you're not giving, you're basically not making up any interest repayments, which means that you don't have to give out cash that would have been used to run your business, right? So quasi-equity, like I mentioned, sits in between equity and debt. So as you can see, like it's right in between. The way we presented our table, we can see that's right in between, right? And there are different types of quasi-equity that you might come across. So there's what you call the mezzanines, which are basically like a debt note, right? Then there's a convertible debt, which is more common with startups in Africa and more developed markets. And then you might have safe notes, which have become more popular with the rise of startups. Now, the difference between quasi-equity and equity is that quasi-equity isn't typically registered with your company, with regulators, in the sense that the Corporate Affairs Commissions does not typically recognize quasi-equity, but it's more or less just an agreement for future equity. That's what it is. It's not, so it's basically an agreement whereby, so you go and meet an investor today, and I say, I want money from you, but I don't want to have to go through the Corporate Affairs Commission to go and register the equity, because that would mean I will pay some stamp duties, or it could also mean that, one of the reasons why you might want to get quasi-equity is that you're not certain about things like valuation. How do you treat valuation? The investor does not want to be fully tied to the company. So that's why you might do quasi-equity. Now, sometimes quasi-equity might have an interest element to it, but it is not paid like a debt. So what happens is that it's paid in kind. It's paid in kind. Then also, the principal is not always paid back, right? The principal is not always paid back. Sometimes it converts to equity. And what can happen is that if you decide not to convert to equity, you can pay the principal back. And then it's also helpful for your risk profile, because you're not paying any interest. You're not paying any interest, right? Then you have the debt portion. So now debts, there are different kinds of debts. There is the secured and there's unsecured debts, right? So unsecured debts are debts that do not have collateral with them, while secured debts are debts that have collateral. Now, the difference between secured and unsecured, besides the collateral bits, is interest. So unsecured debts will typically have a higher interest than the secured debts, because at that point in time, the banks are not comfortable enough to give you a cheap loan. So typically, you most likely would get a secured debt, because most lenders are comfortable providing secured debts, right? Unsecured debt are typically raised from like individuals and microfinance, not necessarily microfinance, but like finance houses, but they typically are few and far between. Now, the beauty about debt is that whoever gives you debt does not have a claim to your company unless you default on the debt. Now, but what happens is that you're very familiar with is that you'd have to repay the debt over a period of time. And then you're also expected to pay interest on this debt, right? Now, why people in finance like debt is that why people in finance like debt is that it's easier so with debt, it's cheaper capital, but then also because you're paying interest, there is a tax reduction on it, right? So you don't have to pay as much taxes because you're paying interest. So debt allows you to reduce the amount of interest you pay, rather the debt amount allows you to reduce the amount of taxes you pay, right? Then there's also the risk element to it. So when you take debt, your risk profile goes up because your chances of not being able to pay back increases. So debt is typically more risky because you're obligated to paying the interest and the principal, depending on the terms of the financing you've gotten, right? So it's advisable for companies that don't generate a lot of cash to not take on debt, right? Now, the fourth type of funding you can get is grant funding. Now, this is equity free, right? It has nothing to. Whoever provides you with grants is not looking to take on equity in your companies, right? So they might require you to pay back the principal amounts eventually, or they might basically forego the principal. But basically, this is equity free. There are no rights to the assets. There are no obligations. The obligations you might have with regards to grants are basically maybe meeting milestones and criteria that you might have, right? All right. So businesses have different life cycles, right? So just like businesses are just like human beings, right? You're born. When you're born, you come out as a baby. You go through your toddler stage, and then you go through your pre-adolescence and adolescence before you become an adult, right? So businesses to have that cycle, they go through a time where they're teething and they're basically struggling to survive, and then they build their muscles, they build their understanding of how to operate, and then they become matured and start to go fast and start to take things on their own. So just like human beings, just like every given thing, a business has a life cycle. Now, in finance or in venture capital, we see it as 5 stages, right? The first stage we call the pre-incubation or the pre-seed or incubation stage, which is basically the idea stage. So at that point in time where your business is just an idea, right? Then after that, you have the seed stage, which is you taking your idea into a tangible product, right? Then when you proceed from the seed stage, you get to the growth stage, which is where everyone likes your product, everyone likes your business. So you're getting customers you're getting a lot of customers, and they're coming back to you, right? And then the final stage is, or rather, the intermediate stage is the scaling stage, right? The scaling stage, which is basically you've gotten customers that are loyal to you, and you're basically going into new markets and going into new locations. And then there's the final stage, which is establish your market position. That's where everybody knows you. You're the leader in your market. Now, in these various stages, there are different. You have different kinds of investors that would invest in you. Now, the challenges that entrepreneurs face when they're raising capital is that they do not match their funding needs and their funding with where they are as a business. So now imagine trying to give a baby alcohol. That baby will not grow. or having a someone under 18 trying to buy alcohol, for example, you won't sell. The retailer would not sell to that person, right? So it is for businesses that are very early stage and are trying to raise, say, $50 million or $20 million, and they don't have any revenue, they don't have any product, right? So the different kinds of investors for you at a different point in time of your business, right? So when you're in your idea stage, the best type of capital for you are typically, first of all, your own capital, because no investor would give an entrepreneur money if they don't have their own commitments in the business, right? So an investor always wants to see that an entrepreneur is committed to their business. So that means you providing your business with providing your business with some form of funding, right? Then at that point in time, they would like to see that family and friends have put in capital into your business, right? Then at that point in time, you might see grants that would be suitable for you, and then you might have incubators and accelerators that would want to that would be a right fit for you. Now, the next stage, which is the seed stage, which basically is where you're trying to find product market fit. So what finding product market fit means is finding the right set of products and right set of services that would address a large pool of customers, right? So it's because sometimes you have a business idea, but you might like it, but not everybody would like it, right? So product market fit is finding that product, finding that design, finding that accessory that would allow you reach lots of people. Now, at that point in time, you're still not ready for big money, right? So you might see some angel investors that are looking to invest in you at that point in time, right? And at that point in time, you might see accelerators who are willing to fund you, right? Then by that point in time, they're giving you capital so that you can find that right product, you can find those right designs, you can find those right distribution channels that will allow you get the right customers, right? Then once you found that product, once you found that design, once you found that product, basically, you now enter growth stage. So now typically you would hear, so if you read news about funding in the startup space, you would hear stuff like pre-seed, seed, series A, series B, series C. Typically there used to be, or before now, there used to be an investment amount that classifies you as a series A or series B or pre-seed company. But what we've seen in the last few years is that a lot of startups have raised a lot of money at the pre-seed stage that typically will be meant for this growth stage or the scaling stage. So in recent times, we try to shy away from that nomenclature of Series A, Series B, Series C. But ideally, when you're thinking of your Series A, you're thinking of growth stage. So you having traction and you having repeat customers and you now being ready for venture capital firms, right? Then once you go past the growth stage, you get to the scaling stage. So that's what you typically would see as a Series C, Series D, which basically you're trying to go to new markets, right? And at that point in time, it's venture capital firms and banks and strategics that are suitable for you. Then later on in your life cycle, when you become more matured, you're not thinking about going to the public markets. You're going to list. You're thinking about going to list on the stock exchange, or going to raise money from a DFI or a sovereign wealth fund, or getting like big bank loans, basically. So, like I mentioned, there are different stages for you as a business. There are different stages for you as a business, right? And you raising capital, depends on, or your ability to raise capital depends on you understanding what you are as a business, right? So am I still at the idea stage, or am I at the stage where I'm trying to find the right products and or the right designs or the right structure to be able to scale or to be able to get like lots of customers, right? Or am I at that point in time where I've already found the right products, I'm getting lots of customers, I'm getting $1 million worth of orders, everybody knows my name in the market, right? Or am I at that the scaling stage where I'm trying to go into different markets, trying to get into different kinds of businesses? Or so all of these stages basically allow you to allow you to be able to understand what kind of capital is suitable for you, right? So now I saw a question on who is a strategic, right? A strategic basically is a corporate, a corporate or a business that invests in other businesses. So in South Africa, biggest strategic is Naspers, which is a media company that invests in companies like MultiChoice and the likes. You can also see Standard Bank as a strategic. So basically, like strategics are companies that invest. So like an Apple is a strategic in fashion, and ASOS or a LMH is a strategic. So basically, corporates that invest, those are who our strategics are. So now, what are incubators and accelerators? So right now you're in an acceleration program, right? But incubators and accelerators are basically entrepreneurial support organizations that help founders get to achieve their dreams, basically. So when you start out, you typically, when you start out, you typically don't have so much capital, right? And you typically don't understand so much about business, right? So it's very advisable for you as a founder to utilize accelerators and incubators when you start as a business. Now, incubators and accelerators, that's what you call entrepreneurial support organizations. They do a lot for you as an early stage founder, in the sense that they might provide you with capital. So some incubators and accelerators might provide you with equity, or they might provide you with grants, right? Then some other things that incubators and accelerators provide are workspace, which is helpful in terms of your cost, right? Then it can also be mentorship, which is access to people who understand your business or understand business and can advise you. Then there is entrepreneurial education, so being able to sit in classes that will help you understand business and help you understand how to go about business. Then accelerators also help you in accessing investors, right? So your first set of investors may come from the investors that your accelerators introduce you to. Then accelerators also work closely with strategics. So you find out that a lot of accelerators are sponsored by strategics, so like say like an Airbus or a Facebook or a Google, right? Now, why they are doing this is largely because businesses understand that if they don't innovate, they will die. So and sometimes when it gets to a certain stage, they are unable to innovate properly. So what they do is that they start to invest in startups who can help them innovate. So think of all the products you see with from Google or Facebook. Most times those products don't actually come from them. They come from businesses that they actually invest in and they acquire, right? So that's why strategics invest. So it's not necessarily eliminating competition, but basically improving their service offering. So with accelerators, there are different types of accelerators that you can find, right? So the more popular accelerators are the technology accelerators. And so you might see guys like Y Combinator or Techstars. Now, these guys typically will look for software businesses to invest in. So businesses that are leveraging on software skill, right? So you might apply to them as a fashion business and wonder why they are not accepting you. And that's largely because of their investment criteria. But at the same time, there are different types of accelerators that are focused largely on the fashion and creative space, right? And a number of them are in Africa, particularly East Africa, and they focused on a variety of things from apparels to leatherworks to clothing and textiles, right? And a lot of them are focused on sustainability because some of the things that accelerators and so most of these accelerators are typically funded by strategics, right? And some of the things that these strategics are trying to do is to improve the ways in which they do things, right? But then also improve sustainability of the businesses, which is why they partner with accelerators. And a lot of the important things to be seen now with accelerator programs, particularly in the creative space, is sustainability and circular economy and whatnot. So some accelerators that you might see include Fashion for Goods. So now they are based in Kenya, and they basically are focused on innovation in sustainability and circular economy, right? So reducing waste in fashion, because like one of the common themes in fashion these days is fast fashion and the trends in fast fashion, right? Then there is the IFM very main accelerator. It's not country specific, and it's focused on a variety of locations, not just Africa, but in the diaspora. And the goal is basically to get strategic and operational supports for their awardees or their grantees and whatnot. Then you have Leather Impact, which is largely focused on leather, and you have Growing Innovation Program and the Kibera Fashion Incubator in Kenya. Then there are a few others like the Drumstart Accelerator, Accra Accelerates, African Fashion Fund, Ethical Fashion Initiatives, and the Textile Accelerator Program. Now, what these accelerators do is that they are largely focused on improving the access to capital for businesses like yours, right? Then also improving the survivability. So that means the potential for a business to survive for more than a year or 2 years, right? Which means getting access to resources and getting access to investors and whatnot. And then also they're supporting trends that are important to the global economy. So I see a question asking about what circular economy is, right? So one thing about the fashion industry, in at least from the 20th century, has been the rise of fast fashion, which is basically high-end fast consumer brands, which tend to change, which tend to introduce like new trends and new designs every single quarter. So you have your fall collections and your winter collections and whatnot, and which force people to change their clothing and wardrobes and whatnot. So this has become a challenge for the environment from a climate perspective, and also from just a general environmental perspective, right? So circular economy is basically being able to reuse old products without having to create new ones, right? So ensuring that beyond just a single use, there is you can use clothing items beyond just the first initial use, right? It also means converting waste in the environment into usable materials like fashion and whatnot. So imagine transforming plastic bottles into shoes and what. So beyond the accelerators, there are the angel investors, right? These are typically individuals that are willing to provide some kind of capital to investors, right? Right? And why did they do this? They do this either because they were successful entrepreneurs or successful business people before now, either in that particular field, so whether it's fashion or whether it's technology, and see the need to support entrepreneurs like them or who were like them at one point in time. Now, what they do is that they typically would try to take up somewhere between 10 to 20% of equity in your business, right? And they typically would use convertible notes, convertible equity, convertible quasi-equity to make an investment in your company, right? Because they do not have the time and the headache to, they don't have time to face the headache of registering your business and whatnot. Now, what angel investors do is that they act as mentors, right? Because they've been there before you. They understand where you are as an entrepreneur or as an operator. And they also have networks. So networks of investors, network of strategic partners. So whether it's a fashion brand, whether it's a retail chain, whether it's a supplier of certain material or whatnot. So they typically would have resources that they will help you out with. So they typically so angel networks and angels are basically the first set of investors you will get in your business after your family and your friends, right? And they are not grant providers, right? So they are they sometimes operate in clusters, which are called angel networks. So in there's the African Business Angel Network. In East Africa, you have the Kampala Angel Investment Network. There's also the Nairobi Angel Network. In Nigeria, you have Lagos Angel Network. They also, a number of them in North Africa, particularly Egypt, Tunisia. So in almost every single country, there is an angel network. And these are the first set of people who typically would invest in businesses in any emerging markets. So now, how do I find an angel investor, right? So like I mentioned, angel investors are either people that are successful in business or did really well as employees and go to a high level, right? And so they have disposable income. Now, your best angel investor is someone who has experience in the industry that you operate in or in the value chain of the industry you operate in. So you're thinking of an angel investor who's been successful in fashion or textiles, right? So you have to first of all identify, do your research. So who are the big brands there in that space, right? And who are these entrepreneurs who have done this in that space, right? So it could be from a perspective of who are the oldest businesses in this space, or who are the businesses that have raised the most money in this space. Now, your investor might not necessarily be someone who does exactly what you do, right? They also are people who might have some level of experience in an industry that is favorable to yours. So, for example, if you're in fashion, right? If you're producing apparels, you might need an investor who has a retail business, who is good at selling, right? That investor will be very beneficial to you, right? And why would that kind of investor be beneficial to you? Now, this is to your question, Olateju. Basically, investors aren't necessarily there to run your business. They're there first of all to make money, right? So they're investing in you so that you can actually develop your business and grow your business to the point whereby they can make a return, right? Now, what they can do to help you get to that point is by advising you, right? By giving you advice on how to do business. So you might have a challenge with understanding how to price your product. Your investor is always going to be there to help you with that. You might have challenges on understanding where to get certain materials from. a good investor or a good angel investor will be very beneficial for you in that regards. Another challenge would be you might have difficulty understanding how to establish supply chains, right? So an angel investor would do that for you. So angel investors are typically people who would help you, who advise you on taking the next step. So that point in time when you're trying to find the right products to get to the right markets, an angel investor is helpful for that. So now next question is like, does that mean means they invest not necessarily in cash? Well, firstly, so you could have different kinds of investments, right? You could have sweat equity, you could have cash. It's preferable for you to get cash from an investor because you're giving equity away from your business, right? So the sweet spot for you is getting cash, but also getting cash from somebody who understands your business, right? So now, once you understand what kind of angel investors are successful in your industry, you also have to understand where they are, right? Where to find them, right? So sometimes they have clubs, they have networks, right? So look up your local angel networks. Then always apply to accelerators and incubators, right? Because they typically would have access to angel investors and programs that will be helpful for you. Now, after angel investors, you have venture capital firms. Now, these are basically people who they're basically companies that write equity investments, or rather, they're companies that invest in other companies, right? And what they do is that they've raised money from investors to invest that money, right? So it's venture capital investors have to return the capital they've raised to their own investors. So when they are looking for investments to make, they typically would be looking for the fastest growing businesses, right? So sometimes when you meet a venture capital investor, you might have a great conversation, but they typically won't invest in you because they're trying to look for very fast growing businesses, right? Not just businesses that are growing 10%, 20%. So the ideal venture capital investment is the business that grows 100%, 200% year on year, right? Now, when your businesses are, the ability for a business to get venture capital investments depends on how much traction you've gotten, right? And you won't always get venture capital investment on the first day or in your first year or your second year. It takes a while, right? So by that point in time, when you're getting venture capital investments, they're typically looking to get between 10 to 30% of your company, right? And they are kind of like angel investors in the sense that they provide you mentorship, they provide you access to investors, they provide you with partnerships, right? But then also, venture capital firms typically invest in other businesses, which could be helpful for you, right? But basically, the number one question now entails how can I get venture capital investments? So VC investors typically have different criteria, right? So some of it is industry. So some VC firms might not invest in certain industries. So some VC firms are focused on healthcare. Some VC firms are focused on fintech. You will find out that a lot of VC funds are focused on fintech, right? But then there are also some VC funds that are focused on creative economy and fashion and whatnot. So the first question you have to ask any venture investor is what industry do they invest in, right? Then also the other question you have to ask is what their average ticket size is, right? So typically sometimes what you're looking for in investments is like $3,000, right? And most times these venture capital firms are looking to invest $50,000 or $100,000 or $2 million, right? And just because they you're looking for money and they have money doesn't mean they can invest in you. So now Oluwadunsin says that VC firms don't believe in fashion. So that's not necessarily true. So the problem VC firms have is that they are trying to return money to their investors. So they're looking for the fastest growing businesses. So you find out that more VC firms are invested in fintech than any other industry. Not even healthcare, not even agriculture. So it's what you've seen, what we've actually seen successful. We've actually seen successful venture investments in fashion, which I would point you to. So VC firms, let's think of scalability. That's what we call scalability. So our scalability for them is how fast can you grow? How fast can you get to $10 million? How fast can you get to $20 million, right? So those are the kind of businesses that VC firms invest in. So not just any business, right? So it could be a furniture business, it could be an e-commerce business. But if you're not fast growing, a VC firm will not invest in you, right? And there are different ways in which you can capture the value chain, or rather, different ways in which you can get venture capital investments, right? So now, like I mentioned, VC firms aren't just exclusively focused on fintech and healthcare and whatnot. They actually have been successful investments in fashion and textile and whatnot. So there's a particular investment there's particular investment in the creative fashion and textile space that is popular, and I'm very sure a number of you here probably use them. So they're called Africa. Or they were initially called Africa, but now the brand is called Anchor, right? So I believe they're based in either Cote d'Ivoire or in Francophone West Africa. And they've received investments from a number of people that we actually co-invest in, right? So what Africa does is that they basically have become an online platform for African-inspired clothing, right? And they've since they started, they've been able to process $35 million worth of transactions, right? They've raised money from a variety of investors, not just in Africa, from all the way from the US, like people like Vested World, to Nigerian investors like Lofty Inc. and Consonance. Now, what these guys were able to do was that they said, rather than us being the manufacturers, can we be a platform? So can we be the Jumia for fashion? And that way they were able to embed technology into their products, and they're able to create a business around technology. So while it's focused largely on fashion, it's not necessarily the manufacturer, right? Now, this kind of business is very, very attractive for venture capital firms. Then also, one thing that they focused on was that the consumer market was largely, the consumers are largely diaspora, which are people that have like high disposable income and high potential for them to be able to do large numbers quickly, right? So that's why they've been able to do $35 million worth of transactions quickly, right? So beyond just the VCs and the angel investors, there are crowdfunding platforms and their syndicates. So syndicates are kind of similar to angel networks, but they are different in the sense that that they invest. So there typically is a fund manager. There typically is an investor who manages the syndicate. So, for example, CCOP has the CCOP syndicate. So while they're angel investors in the syndicate, it's managed by CCOP. Same thing with Future Africa. Same thing with Vulture Capital. Now, these guys are similar. So their requirements are similar to VC firms, similar to angel networks, and they provide the same services, right? Now, there's a difference between crowdfunding and syndicates, right? So crowdfunding, guys like Kickstarter, GoFundMe, Rocket Hub, these guys typically won't take equity, right? So they typically are a way for you to gather people who like a business idea, I want to give money to the promoter or the innovator to be able to achieve that business idea, right? So there are a few brands that have launched through Kickstarter and whatnot. So like I know of one called Salibata who have gotten funding from crowdfunding and whatnot. Then you have like guys like Kicks and Wiku and whatnot. So there's a private equity firm. So private equity firm that the likes of Verod, Africa Invest, DOB Equity. Now, these guys are typically focused on you when you start making $2 million, $3 million worth of capital, right? And whatnot. So private equity firms have been very big on the fashion space. So you have the likes of KKR, who are invested in SMCP, right? KKR is one of the biggest private equity firms in the world. They are notorious for the acquisition of RJR and Nabisco in the 90s, right? And what they typically will do is that they will typically buy a business that has high cash flow and high cash flow, high revenues, low high margins, right? And they're able to now grow it, make it more efficient, right? And sell it to other businesses. So one of the reasons why private equity firms like fashion is that, particularly in the retail side, is that there's so many things they can do when it comes to scaling to different countries. There's so many things they can do when it comes to restructuring operations and whatnot. But we've seen successful fashion businesses achieve private equity funding. So the strategics. So like strategics I mentioned are mature companies that invest. So with the fashion space, you're going to be thinking of guys like LMVH, who own Louis Vuitton and the likes, right? You're going to be thinking of big brands and whatnot. So when typically strategics want to own a significant amount of your business, so they could also acquire you. So now, as an entrepreneur, there's one thing you need to take into consideration, right? You taking money from an investor means that so at the point in time when you take money from an investor, that point in time, that business no longer becomes yours exclusively. Now, it's very important. It's very helpful. So a lot of African entrepreneurs find it hard to raise equity because they are not very keen on sharing. But the truth is that sometimes sharing your equity with someone gives you the potential to move from a 5 million naira business or 5 million rand business to a 30 million or 100 million business, right? But then also, there also has to be an end goal for you. So with the difference between technology and a number of other types of industries is that the entrepreneurs in technology are looking to sell their businesses completely at a certain point in time. So some of them are looking by the 10th year or the 15th year, they want to be able to sell their business to somebody else, so like a strategic, so that they can get enough money to retire or buy a house or start another business, start multiple businesses, right? So as an entrepreneur, if your goal is to not just make money for yourself, but build a business that is lasting and goes beyond you, you have to be thinking of pushing your business to be able to be acquired or be able to raise capital from private equity funds and strategics, right? So a strategic might come and meet you and say that, look, I like your business, I like your idea, but I want to buy you out, right? So sometimes it's difficult for you to let go of your business, right? That is usually because you put like sweat and your blood and sweat and tears into it, right? But at the end of the day, is it better to cry in the Corolla or cry in the Benz, right? So you have to think of yourself long term and what you could do or how the sustainability of your business long term, which means raising equity, or which means even potentially selling, right? Well, so Felix asks, what is TMT? So TMT is technology, media, telecoms, media, and technology, basically. So this is a group exercise. We are quickly, we're actually running out of time, so we'll just do this quickly, right? So the question is, what strategic partners can you think of that can enhance your business? Your fashion, textile, accessories, apparel business. So think of it this way. A partner that gives you access to either an audience or customers. So that means like it could be a retail outlet, it could be a media company, it could be a logistics company, or a partner that gives you access to technology. So what type of strategics are you thinking of? And if you can name companies, that would be helpful. A PR agency. African and Anchor, yes, that's a good one. Etsy, great. There could also be so there could also be DHL, LMVH, I like that. Amazon, Folklore. Does anyone think Flutterwave is strategic for them? Flutterwave, Paystack, do you think that they are strategics? Yeah, very many. Stripe. That's great. Thanks for your contributions, right? So strategics. So I mean, as a business, just start thinking of strategics. I like that from Susan, textile mills, right? Because one thing you need to think about as a business is not just about your customers, right? It's also about supply chain. So a lot of people think about the revenue, but sometimes the key to unlock your business is the costs, right? You'll be able to get like better costs for your products and whatnot, right? So I like that textile mills. So I think the final chain of the investor landscape is DFIs. So these are development finance institutions. These are government-owned institutions that help with providing capital, right? So these are guys like FinFund, Norfund, Swedfund, and Proparco. So these guys typically provide debt and equity, but they typically like matured businesses. So businesses that are doing about 2 million or so, but then they tend to have programs for businesses that are SMEs, basically. And they basically act like other investors. But one thing is very important for them. Sustainability is very important for them. So ESG implementation and sustainability. So things like circular economy, like how you think about recycling, how you think about waste, how you think about treating people, how you think about treating employees are very important to the FIs, right? So one big provider of capital for the fashion space has been IFC, right? So they typically they like the fashion space, particularly guys that focus on manufacturing and manufacturing. So things like textiles, things like apparels. They tend to fund factories and provide working capital for businesses in that space, right? Businesses that would employ a lot of low skill and semi-skilled labor and improve them and whatnot. And they typically partner with different stakeholders in the ecosystem, so whether public or private, and their priority is always about sustainability in manufacturing. So if you want to position yourself for funding from DFIs or private equity down the line, even though they are a few even though they are like further down the line, the DFIs and private equity firms, it's good for you to start thinking about sustainability today. So how do you think of waste that is being generated by your business today? How do you think of the amount of women you're employing, the amount of the amount of jobs you're creating, the amount of women in management in your business and whatnot. So those are the kind of things that you need to think about. Your use of clean energy, all of those stuff are very helpful for you if you want to position yourself as a sustainable fashion business that can attract the best investors. So what is capital structure? So we talk about debt and equity and all that stuff. In corporate finance, that is the profession whereby we raise capital for people and whatnot. We like to think of capital structure, so the amount of what funds your business, right? So if you're familiar with a financial statement, you would know what you call a balance sheet, right? So in every company has assets that they use to carry out their operations, right? But that asset has to be funded by something, right? So the asset has to be funded by equity or by debt. So the capital structure is basically the mix of your capital structure is basically the so I see my sister Stephanie. I'll slow down a bit. So your capital structure is basically the mix of debt and equity, right? So it could be your so your liabilities could be the debt you raise from the bank, right? It could also be the working capital or the credit that your supplier gives you. So like let's say you buy fabric from a supplier and the supplier says, okay, pay me in 2 weeks or pay me in 21 days. That's capital for your business in a way. Then there's equity and whatnot. So capital structure basically is thinking of how to balance equity and debt. So why is capital structure important? So capital structure is important in optimizing the value of your business. So sometimes it's helpful to raise debt because it improves the value of your business long term, right? Then also debt could also mean that you do not pay as much taxes you use more of that capital to sustain your business, right? Then the other thing is that with debt, we could be more efficient with your use of capital and whatnot. But the truth is that there are a few things that determine whether you're able, what kind of capital structure you can that you can hold, right? Now, the first one is cash flows. Now, if you don't generate enough money to pay debt, it's highly impossible. It's highly unable. It's not possible for you to be able to go to the bank and get funding. So typically in credits, in lending, there are 3 C's we think of. There is cash, there's cash flow, there's collateral, and there's character. So what a bank sees when they're trying to make a credit assessment is, first of all, are you generating enough cash? The second thing is that do you have enough collateral to be able to cover the loan you're taking, right? And then the last one is your character. So yes, you might have the ability to pay, but what is your willingness to pay? Now that last C is the hardest part for them to determine. So that is why they put a lot of emphasis on the first 2 C's, which are the cash flows and your collateral, right? So even if they don't know who you are, they don't know who your parents are, they don't know who your family and friends are, they know that they have enough, they know that you have your car. So the last C is character. So that's your personality, right? So even if they don't know how much, even if they don't know who you are as a person, they know that, okay, you have a car that can cover the loan that you collected, or they know that your business is able to generate enough cash to cover the loans, right? So sometimes when you come to a bank with a business plan, they are unable to fund you because they are not able to determine how much cash you can generate to service the loan. So banks will typically think of your last cash flow, not your future cash flows. So that's one of the challenges with going to the bank to raise money, right? Then there's the interest coverage. So if you generate do you generate enough money to service the interest? Then also there's the cost, right? So beyond just you paying interest and you paying the principal, there's simply a cost attached to taking debt. One of which could be insurance cost, another of which could be administrative cost to the banks and whatnot. So there are always those hidden charges that are not said when you're trying to take a loan. Then there's flexibility. So do you really have enough collateral to do you need have enough collateral to, or rather, do you have enough cash flows to take up additional debts? So one of those things asks that if I'm asking for 5 million naira loan, do I have to have 5 million naira of collateral? So yes and no. So it depends on the criteria of the banks or what whoever is providing capital, the microfinance bank. So most times the banks either want 5 million, or they might say they want 1.2 times coverage. So that would be about, so like if you're looking for a 5 million naira loan, the bank will want you to bring a 6 million naira worth of collateral, or they might ask you to bring 7.5 million naira worth of collateral. So it depends on their risk assessment, right? But then some lending agencies who are not banks, who are more developmental focused, might ask for a lower collateral. Some might ask for bank guarantees, like with Bank of Industry. But at the end of the day, you typically will need the collateral with the same amount of capital of collateral, right? So no collateral, no loans. So basically, these are some of the reasons why you need to think about capital structure. These are kind of things you need to take into consideration, right? But then again, there are different people that have different types of loans, right? Some might not require collateral, and they're typically developmentally focused. So they're either funded by a development agency or a foundation or something, or the government, basically. And then certain government programs might require, so also you might not necessarily have to borrow off of, so some borrowing could actually be based off of your cash flow. So for example, if you have invoices worth of 5 million naira, you could probably get a loan of 3 million naira off of those invoices. So there are other creative ways of raising capital. If you're able to determine, like, there's some solid source of capital, or some solid source of cash flow, you're able to raise loans. So it might not necessarily be from your collateral, right? It could also be from your invoices. It could also be from your transaction volume. So guys like MoneyPoint or Traction, guys that provide you with POSs, can also provide you with capital because they know your revenues are like. So we'll quickly run through the rest of the slides so that we can have more questions and answers. So basically, there is like I mentioned earlier, the different stages in the corporate life cycle, and this is a graph by Damodaran, one of the prominent professors in corporate finance, right? And what he typically says is that businesses should have certain types of certain businesses at certain stages have different funding needs. When you're at the early stage, when you are barely when you are still young, you need all the cash that you can get as a business, which means that you can't afford to be paying interest. So it's advisable for you to focus on equity. But when you become more profitable, when you start generating more cash flows as you grow, then you should not be more comfortable taking debts, right? So typically, it's advised to young startups is try and focus on equity and equity-free sources of funding rather than focusing on debts, right? You can find more creative ways to get debts, so from your invoices, from your transaction volumes. You should to think of alternative ways of getting debt rather than looking for collateral and whatnot, but also go for the lowest possible form of debt. So what do investors want? What investors expect? So investors aren't looking for business ideas. They're looking for tangible businesses, right? So don't just wait for an investor to give you money before you start to execute your business idea. Start, right? Then also when you build, when you're building your business, don't think of your business as just enough for it to sustain you and your family. Think of it as, look, I want to build a business that is going to employ 100 people, 200 people, build skill. Then also try to understand your business from the accounting perspective. So understand your business not just from the day-to-day, but also from the numbers part of it. Understand what your revenue is, understand what your sales cycle is, understand what your margins are. These are very important for you as a business, right? As an entrepreneur. So what do we investors see, or what do we investors want think of when we're looking at businesses? You want to see a strong team. You want to see a large market. You're operating in a market that's big. You want to see that you have some level of traction. So you're not just having zero revenues today. Maybe you have $50,000, you have $100,000, you have $10,000, right? You have to have some level of traction. Then you have to have a strong, unique selling point. So what makes you competitive from other businesses, right? Then also, the kind of business you're operating must be easy to understand, not complex, right? Then also your business must be able to generate cash. So if your business isn't generating cash, it's hard for investors who want to invest in you. So what's your ideal investor? Your ideal investor is someone who has a reputation, right? Particularly in the fashion space. They have the expertise when it comes to supply chain, when it comes to marketing, when it comes to sales and distribution. They have your time. They're able to speak to you. They're able to answer your problems. They have a network of people that can help you out, right? Then they also have resources. So whether it is financial, whether it is regulatory, then they also have relationships, right? So there are many other places where you can get resources for the presentation and whatnot. Let's find out more about like opportunities, right? So at this point, I would take any questions.
Hi, Rofem. We have been collating questions as the session has been going along, and right now, just with the time, we probably just have time for about 3 questions. Thankfully, a lot of the questions that have been asked in this session, you've been answering them as you go along. So the first out of the 3 questions, what does it mean when they say the business is not scalable, and how can you make your business scalable?
That's a very good question. So scalability is relative, right? So but when investors say scalable, what they mean is how fast can your business grow, and how wide can it grow, right? So can it go from making just 100,000 naira today to making 30 million naira tomorrow, or in 2 years' time, right? Then also, are your customers only based in your particular location, right? So a scalable business is one that can reach a wide market and can reach a wide audience, and can go from one country to the other, one market to the other. So it's not just in Nigeria, it's in Kenya, it can also go to Egypt, it can also go to South Africa, right? So think of tech companies. And now guys like Paystack and Flutterwave, they are not just in Nigeria, they are in Kenya, they are in South Africa.
So when investors are thinking of scalable businesses, they're thinking of businesses that don't just function in one particular market and aren't just comfortable with just making a small amount of money they've gotten, but are able to get to the millions and get to millions really fast and go to like different markets. So I hope that's helpful.
Well, thanks for that, Profem. Second question out of the three. Do these angel investors have a say in how you run your business? Are they allowed to change your business process, or they just lend advice?
So unless you're collecting money from Elon Musk, an angel investor won't change your business, right? So they only invest largely to provide guidance, right? So they are mostly there to provide advice to you and not change your business. So they might give you insights that would eventually dramatically change your business, but at the end of the day, they are not there to run your business, right? And most times they only own a small percent of your business, so they can't have a say in your business, right? The only point in time in which they can change your business is if they have more ownership than you do as a founder. So yeah.
Okay, so this question is 2-in-1. And are there any type of investors that will give you money, but instead of taking a percentage of the business, they'll take their money back after a period of time? And then the other side of this question, can you collect your equity back from an investor in the future? If yes, how can a business collect back an equity?
Yeah, so that's a great question. So individuals can lend money to businesses, right? And so typically, an investor who's giving you money and expecting their principal back is a debt investor. So that could be a bank, that could be an individual, right? So they do happen, right? But also institutional quasi-equity. With quasi-equity, the investor has the option of getting their money back rather than getting equity, right? Then the second question is about is there a time in which you, if I'm correct, is the ability to buy back your shares, right? That you sold, right?
To get back your equity.
Yeah. So yes, you can do that. You can do that as a business, but it's expensive. So it's not typically advised. It's not typically advised for businesses to do that, right? But you can actually buy back shares from your investor. But then the different questions now arise. So one is valuation, so our value, because the investor won't be expecting to just so let's say the investor invests 100,000 in you. The investor isn't just expecting 100,000. The investor might be expecting 500,000 or 600,000. So it's possible for you to do that, but it's typically not advisable for you to do that.
Thanks, Profem. So just with the questions that we've collated, we'll share them with you, see if there's any that you didn't answer, and then you can answer them and send them back to us. And then we will share them with the participants. Thanks for the session. You have come in towards the tail end of the session. So today we have a bit of housekeeping to do. So if you'll just allow me to move on to the announcements real quick. So participants, as you know, we've reached the final week of the 8-week Fashionomics Africa Accelerator online program. Congratulations all for your dedication and hard work. Yes, you've been highly engaged in this program, and it's clear from the questions and the comments that you've been asking in all the sessions and the Founders Day series. We are happy to see that there's quite a bit of great learning that has happened, and we hope you can translate this into practical lessons to grow your businesses. So yes, as we all know, all good things must come to an end, and the end of the Fashionomics Africa Accelerator online program is drawing near. We have one more session tomorrow, which will be setting expectations and developing a pitch deck. And the final exam will be administered this Friday, we will start off by recapping some major concepts of the Fashionomics Africa Accelerator Program. And then we will share the exam link in the Zoom meeting in your emails and WhatsApp group. We have shared a Google link with the learning session presentations. You'll receive it again in this chat session. Labake, if you could please post it. So we'll say it again in this chat session, in this Zoom chat session and the WhatsApp group. And then what you will need to know about the exam. First things first, you have been highly engaged throughout the learning sessions, and the exam will be measuring your understanding of what has been covered. So please don't panic. Just ensure you review the learning material and you'll be fine. Again, we will be sharing, you've already been shared with this material. We'll share it again in this Zoom chat and the WhatsApp group when we open it after this. So please remember, a key requirement of this program in order to progress to the next phase is for you to complete this final exam. We request that you aim to complete the exam this Friday. And if you're not able to do so—
Sorry, Naomi, sorry to interrupt. Is the exam on Friday or Thursday?
Sorry, the exam is on Thursday. Sorry about that.
Okay, and just clarify the date as well. So Thursday, the 22nd of December, just so there's no confusion, right?
Yes, my apologies for that. Yes, it's Thursday, 22nd.
Thanks, sorry to interrupt, carry on.
Thanks. So if you're not able to do this on Thursday, the 22nd, please let us know in advance by writing to us on Fashionomics Help Desk at cchubnigeria.com. So what you'll need to know about the exam, you will need to complete the exam within an hour of starting it. Please note that the exam is timed. The exam will have 30 questions and you're required to answer all of them. You only have one try to complete the exam. You cannot retake the exam. Once completed, double check you have answered all the questions and submit the hit hit the submit button. Most of you have Google accounts. So for those of you who may not have Gmail accounts, you will need to set up a Gmail account to access the test. So to recap on next steps, there's been so what time is the exam? The exam, we're just meeting the regular time for the session. You know, the training sessions when they start in your respective time zones. You'll come in, and for the first 20 minutes, we are going to recap some major concepts that we have covered over the past 8 weeks. So once we've covered, we've had that brief recap in 20 minutes, then we will release the exam to you. Again, you have Thursday to complete the exam. If you know you will not have completed you will not be able to complete the exam this coming Thursday, we'll give you until midnight West African time to complete the exam. If you know that you will not be able to complete the exam within this time frame, please communicate with us again on Fashionomics Help Desk at cchubnigeria.com. So again, there's been a lot of questions about what's next. We shared this with you in your welcome pack, but we are happy to repeat this again. So first, every engaged participant will be a winner as shared with you in your welcome pack. So immediate next steps are as follows. Selection of 25 participants to participate in pitch training. These participants will have attended at least 70% of the live sessions, which aggregates to at least 11 sessions, and obtain a score of 70% in the end of program exam. Then certificates will be awarded to participants who will have attained at least 70% of the live sessions, which aggregates to 11 sessions, and obtained a score of at least 50% in the end of program exam. We will communicate to you your results in the first week of January. So again, see you tomorrow. Again, all this information you have, please don't panic. We urge you to review the learning material and all will be well. Again, use the Google Drive link with the learning session presentations. You will have received it in your email, today's Zoom chat, and also we will share it in the WhatsApp group. So we will open the WhatsApp group for discussion and we will be available to answer your questions. So again, see you tomorrow at the same time for the final session of the Fashionomics Africa Accelerator online program, which will be session 15, setting expectations and developing a pitch deck.